The dot-com bubble. When adding .com made you a billionaire. Imagine starting a company. No product, no revenue, no customers, no plan. But you put one thing in the name, .com. Suddenly, investors throw money at you. Your stock price explodes. You become a paper billionaire. Not because you built something useful, but because you existed during the right moment in history. This is the story of the dot-com bubble. The era when websites were worth more than factories, clicks were worth more than cash, and saying, "We'll figure out how to make money later," was considered a perfectly acceptable business strategy. Let's rewind to the mid-1990s. The internet is becoming public. Email is new. Websites are new. Most people don't even know what a browser is. But everyone can feel something big is coming. The same way people felt about electricity in the 1800s or cars in the early 1900s. A technological revolution. And revolutions create a powerful idea. Everything will change. Which quickly becomes, old rules no longer apply. That belief is the seed of many bubbles. Investors started hunting for internet companies, not profitable companies, not good companies, internet companies. If you were even loosely connected to the web, you were hot. If you had a business plan with buzzwords, you were hotter. And if your company name ended in .com, you were craved. Companies changed their names just to add .com. And their stock prices jumped. Not because the business improved, not because revenue increased, but because the name changed. That's it. Here's how insane it got. A company called Pets.com sold pet food online. Heavy bags, thin margins, expensive shipping. A terrible business model. But Pets.com had a sock puppet mascot and Super Bowl ads. Its stock soared. Another company promised to deliver groceries ordered online, at a time when logistics software barely existed. Another promised online toys. Another promised online furniture. Another promised eyeballs. Not profits, eyeballs. As in, if we get enough users, money will magically appear later. Nobody could explain how. Nobody cared. Why? Because prices kept going up. And rising prices are the strongest argument in finance. If something is going up, people assume it must make sense, even if they don't understand it, especially if they don't understand it. Traditional valuation metrics were declared obsolete. Price-to-earnings ratio? Doesn't matter. Cash flow? Old economy thinking. Balance sheets? Outdated stuff. A new metric took over, growth potential, which really meant, how big can this story sound? Wall Street banks loved it. They underwrote IPOs, took companies public, collected fees. Analysts issued glowing reports. Media hyped every new listing. Everyone was making money, on paper. And paper wealth feels just as good as real wealth. Until you try to spend it. Regular people got sucked in. Teachers, taxi drivers, college students. People who had never owned stocks before opened trading accounts. Day trading became a hobby. People quit jobs to trade full-time. Why work 9 to 5 if you can make more clicking buttons? Stocks only went up. Every dip was a buying opportunity. Every skeptic was labeled, "Doesn't get it." Sound familiar? At the peak in 2000, many internet companies were worth billions of dollars, while losing millions every quarter. Some had revenue. Most didn't. Some had websites. Some barely had that. But they all had stock tickers. And that was enough. Here's the quiet truth about bubbles. They don't pop because everyone suddenly realizes something is stupid. They pop because money and liquidity run out. Eventually, investors start asking an annoying question. When do we make actual profit? And when that question starts spreading, the music slows. A few companies miss earnings. A few stocks fall. People who borrowed money to invest get margin calls. They're forced to sell. Selling pushes prices down. Lower prices scare others. They sell too. The feedback loop reverses. In March 2000, the Nasdaq peaked. Then it started falling. And falling. And falling. Over the next 2 years, the Nasdaq lost about 80% of its value. Trillions of dollars evaporated. Not stolen, not transferred, simply gone. Because paper wealth only exists as long as people believe in it. Pets.com went bankrupt. So did thousands of others. Office buildings emptied. Servers were unplugged. Employees showed up to locked doors. The sock puppet became a meme. A very expensive meme. But here's the part people misunderstand. The dot-com bubble wasn't wrong about the internet. The internet did change everything. Amazon survived. Google was born. E-commerce exploded. Online advertising became massive. Cloud computing took over the world. The mistake wasn't believing in the technology. The mistake was believing that every company touching the technology was automatically valuable. Big difference. Bubbles don't mean the future is fake. They mean the future arrived, and humans priced it terribly. Too early, too fast, too optimistically. The dot-com bubble teaches one of the most important lessons in finance. A great idea does not equal a great investment. A revolutionary technology does not guarantee profitable companies. And a good story does not guarantee a sustainable business model. The takeaway? When you hear, "This time is different," you should hear, "Valuations are being ignored." When you hear, "We'll figure out monetization later," you should hear, "There is no monetization plan." And when you see companies valued in billions with no profits, you're probably inside a bubble. So next time someone tells you, all you have to do is buy the future, remember the late 1990s, when adding .com to your company name made you rich, until it didn't. Like this, if you never want to lose money because of tech exuberance, subscribe for more wild money stories, and I'll see you in the next one.